Welcome to Wolf's on-demand webinar series. My name is Stephanie Creedon, the Event and Webinar Marketing Manager at Wolf & Company, and I'll be your host for today's webinar viewing. The slide deck of this presentation can be found in the webinar section on wolfandco.com. During today's presentation, the Wolf team will be discussing opportunities that still exist to minimize taxes before 2021 comes to a close. During our annual tax year-end update, our experts will provide an update on the federal and state income tax law changes impacting investment advisors, broker-dealers, family offices, and private investment funds. During today's presentation, you'll learn tax provisions included in the Buildback Better Act, carried interest update, Massachusetts pass-through entity tax, and tax brackets and key inflation-adjusted thresholds for 2022. But before we hear from Wolf & Company's tax experts, I'd like to provide a brief overview of Wolf & Company. We are a certified public accounting firm offering a full spectrum of services in assurance, tax, risk management, business consulting, and wealth management to private and public organizations and individuals. We leverage over 100 years of experience to address the business challenges of today, combining industry expertise with service specialization to provide your organization with insight, opportunities, and solutions, allowing you to address your unique business needs. We have over 300 professionals working for the firm and have offices in Boston and Springfield, Massachusetts, Albany, New York, and Livingston, New Jersey. So without further ado, I'd like to introduce today's presenters. Michael C. Straven, Principal in the Tax Group at Wolf & Company. Kristen L. Stone, Principal in the Tax Group at Wolf & Company. Marissa C. Harvey, Manager in the Tax Group at Wolf & Company, and Rita Ryan, the International Tax Senior Manager at Wolf & Company. I'd now like to turn it over to Mike to get us started today.
Thank you, Stephanie. And hello, everyone, and thank you for taking the time to join us for our virtual investment roundtable, in which we will provide a year-end update on tax developments impacting investment advisors, broker-dealers, family offices, and investment funds, as well as their clients and investors. Our agenda today will begin with an overview of tax provisions within the pending Buildback Better Act, followed by an update on carried interest, opportunity zones, and digital assets, a discussion on the new Massachusetts pass-through entity tax, and an international tax reporting update. Lastly, we'll do a high-level review of the recently issued tax brackets and key inflation adjustment thresholds for 2022. The Buildback Better Act, commonly referred to as the Human Infrastructure Bill, was passed by the House of Representatives on November 19th and is awaiting a vote within the Senate. While Senator Schumer and the Democratic leadership want to vote on the bill before Christmas, timing of the vote and passage is still uncertain. Since being passed by the House, the bill has lost some momentum as the Senate has had to prioritize a funding bill, as well as legislation to increase the debt limit. The bill has also run into procedural delays as the Senate parliamentarian continues to review the legislation to ensure it qualifies for consideration under the reconciliation process, which would allow the package to be passed with only Democratic support. In the meantime, there's been some infighting among Democrats regarding the framework of provisions related to the state and local income, or the state and local tax deduction. While the House bill calls for increasing the cap on the SALT deduction from $10,000 to $80,000, there is some disagreement among Senate leadership over the SALT provisions. Early on, Senate leadership seemingly agreed upon a proposal that would allow an unlimited SALT deduction for individuals with income between $400,000 and $550,000, as well as couples with income roughly double those amounts. However, over the course of the past 2 weeks, Senator Bernie Sanders and others have expressed increased opposition to any increase to the SALT deduction for high-income taxpayers. Assuming consensus can be reached among the Democrats regarding the SALT provisions, passage still faces uncertainty due to Senator Manchin's continued hesitancy to support the legislation over his concerns regarding its inflationary impact. Given the Consumer Price Index report issued by the Labor Department on this past Friday, his concerns and hesitancy are not likely to wane. Meanwhile, his vote is critical to passage under the reconciliation process, since it only requires a simple majority and no Republican support is expected within the Senate. Since the Democratic caucus is confident the SALT provision and the parliamentarians' vetting will be completed in time for a floor vote before Christmas, it seemingly all comes down to Senator Manchin's willingness to provide the critical 50th vote for approval. As passed by the House of Representatives, the Buildback Better Act is less expansive than originally proposed, not only from a cost perspective, but also as reflected in the following slides with respect to the tax provisions. While the original proposals included increases in the corporate, individual, and capital gains rates, with the exception of a new alternative minimum tax for the largest corporations, an excise tax on stock repurchases, and a new surtax on high-income individuals, the statutory tax rates have remained unchanged. Furthermore, proposed changes to carried interest holding period and the rollback of the current gift and estate tax exemptions were also excluded from the legislation ultimately approved by the House of Representatives. So we'll start off by looking at some of the business provisions within the Buildback Better Act. As I mentioned earlier, there were initially some proposals to increase the corporate income tax. However, those were not included in the final version passed by the House. Instead, included in there, the act approved by the House did add a new corporate alternative minimum tax at a rate of 15% that will be applicable to corporations that report adjusted financial statement income in excess of $1 billion on their financial statements. This new corporate alternative minimum tax is effective for tax years beginning after December 31st, 2022. In apparent response to an increase in stock buybacks since the reduction in the corporate tax rate under the Tax Cuts and Jobs Act that was enacted at the end of 2017, the Buildback Better Act imposes a 1% excise tax on publicly traded corporations for the value of any stock that is repurchased by the corporation. The provision will apply to repurchases after December 31st, 2021. And one important note is that the excise tax is imposed upon the corporation, not the shareholders. Interestingly, based on reporting by the Congressional Joint Committee on Taxation, the government anticipates that the tax will push companies to shift some of their shareholder distributions to dividends, allowing the Treasury to collect more taxes from corporate distributions, since dividends are fully taxable while repurchases are taxable only to the extent the distribution exceeds the shareholders' basis in the repurchased shares. Buildback Better Act also included a deferment of some provisions with respect to R&D expenses. Historically, taxpayers have been allowed to deduct research and experimentation costs in the year in which they are incurred. Under the Tax Cuts and Jobs Act that was enacted at the end of 2017, beginning in 2022, research and experimentation costs were to be amortized over a 5-year period. A House-approved bill delays the amortization provisions until 2026. Moving on to the individual provisions, one of the more popular, or one of the provisions that has received the most attention is the increase in the state and local tax deduction. Individuals are generally allowed to claim an itemized deduction for state and local income and property taxes. Under the Tax Cuts and Jobs Act, the deduction for 2018 through 2025 is limited to $10,000. The bill passed by the House of Representatives increases the cap on the SALT deduction to $80,000 and would be effective for 2021. Currently, also, the Buildback Better Act also adjusted the period in which the SALT deduction would be subject to a limitation. Currently, the limitation, the $10,000 limitation, is set to expire at the end of 2025. However, the Buildback Better Act would extend the cap through 2031. As discussed earlier, this provision is almost certain to change in the Senate. Alternative proposals being considered in the Senate would provide for an unlimited deduction for taxpayers below a certain income level. Consistent with President Biden's pledge not to raise taxes on households with income less than $400,000, Senator Sanders, among others, has proposed setting the threshold at $400,000. Senator Menendez of New Jersey, otherwise, has alternatively been pushing for the maximum deduction Congress would be allowed without adding to the deficit over the 10-year recognition period. Based on projections by the Congressional Joint Committee on Taxation, the corresponding income levels would be roughly $550,000 for singles and $1.1 million for couples. Meanwhile, Senate Republicans have also indicated they intend to introduce an amendment to retain the existing $10,000 cap. So with respect to the SALT deduction, it's fair to say that we should stay tuned for more details over the upcoming weeks. Limitations on excess business losses. Under the Tax Cuts and Jobs Act, the amount of losses that an individual may deduct from trades or businesses carried on through sole proprietorships, S corporations, and partnerships is capped at an amount indexed annually for inflation. For 2021, the limitation is set at $262,000 for singles and $524,000 for married couples. For 2022, the limitation increases to $270,000 and $540,000 for singles and couples, respectively. Disallowed losses are carried forward to subsequent years. There'll be no changes to that under the proposed under the provisions within the House-approved Buildback Better Act. However, under the current law, the limitation is set to expire at the end of 2025, but the House-approved bill would make these provisions permanent. Expansion of the net investment income tax. Since 2013, in addition to the federal income tax, individuals have been subject to a surtax at a rate of 3.8% on the lesser of net investment income or modified adjusted gross income in excess of designated amounts. Net investment income consists of three categories of income. The first category consists of typical investment type income, including interest, dividends, annuities, rents, and royalties, not derived in the ordinary course of a trade or business. The second category of income subject to the net investment income tax is trade or business income from a passive activity or from the trading in financial instruments. The third category of income subject to the net investment income tax is net gain from the disposition of non-business income, including investments, the sale of investments generating category 1 type income, as well as passive activities. Accordingly, since the enactment of since the net investment income tax came into effect, income from partnerships or S corporations in which an individual materially participates, as well as gain realized on the sale of a partnership or S corporation stock in which an individual materially participates, have historically been excluded from net investment income and not subject to the tax. Under the House-approved bill effective January 1st, 2022, the 3.8% net investment income tax would be assessed on non-passive income from partnerships or S corporations, as well as gain from the sale of non-passive activities. The new rule would apply to single filers with taxable income of $400,000 or more, as well as couples with taxable income of $500,000 or more. As previously mentioned, the Build Back Better Act did introduce a new surcharge on high-income individuals. Beginning in 2022, the Act would impose a 5% surtax on an individual's modified adjusted gross income in excess of $10 million at a rate, or as I said, a 5% surtax on an individual's modified gross income in excess of $10 million, as well as an additional 3% tax on amounts in excess of $25 million. The 5% and 3% surtax would also apply to estates and trusts with modified adjusted gross income of $200,000 and $500,000. As defined within the Act, modified gross income includes or equals adjusted gross income less investment interest expense. Moving on, there were a number of provisions included in the House-approved Act that included a number of revisions to IRA contribution limits, as well as required minimum distributions for high-income individuals with high account balances within their retirement plans. Taxpayers are currently allowed to contribute to IRAs regardless of how much they already have saved in their retirement accounts. Individuals who are not active participants in an employer-sponsored retirement plan can make deductible contributions of upwards of $6,000 to a traditional IRA. And that deduction is actually increased by $1,000 for any individuals 50 years or older. The deduction is generally limited to the lesser of $600,000 of the individual's earned income. Individuals who are active participants in an employer-maintained retirement plan may make non-deductible contributions to a traditional IRA. Currently, there are no AGI limitations on making non-deductible contributions. To avoid subsidizing retirement savings once account balances reach very high levels, the Buildback Better Act would create, would create new rules for taxpayers with large balances in IRAs and defined contribution retirement accounts. Effective January 1st, 2029, if the total value of an individual's qualified defined contribution plans, such as a 401k or a 403b plan, exceed $10 million at the end of the value of their qualified contribution plans plus their IRAs exceed $10 million at the end of the preceding year, the individual would be prohibited from making any additional contributions to a traditional or Roth IRA. The rule would apply to single taxpayers with modified adjusted gross income in excess of $400,000, and married couples with modified adjusted gross income exceeding $450,000. While important thing to note is that while limiting IRA contributions, the bill would not limit contributions to a defined contribution plan. Accordingly, an individual participating in an employer-sponsored 401k plan could still continue to make elective deferrals up to the annual limitation. There were also changes with respect to the minimum required distribution rules within the Buildback Better Act. Individuals are generally required to begin withdrawing funds from tax-favored retirement plans by April 1st of the year following the later of the calendar year in which they turn 72 or the year in which they retire. After the initial year, distributions must be made annually by December 31st. The required minimum distribution is generally calculated by dividing the account balance at the end of the previous year by the account holder's life expectancy based on tables issued by the IRS. Under the Buildback Better Act, passed by the House of Representatives, beginning in 2029, individuals would be required to withdraw at least 50% of the amount by which their aggregate retirement account balances, again, including IRAs and qualified defined contribution plans, exceeds $10 million. If the combined balance exceeds $20 million, the individual would have to withdraw the excess from Roth accounts up to the lesser of the amount needed to lower the combined balance below $20 million or the aggregate balance in the Roth accounts. The individual could then determine the accounts from which to distribute funds in order to satisfy the $10 million limitation. Amounts withdrawn from Roth accounts would continue to be tax-free so long as they are qualified distributions, and the taxable distributions would not be subject to the 10% surtax if they were taken out before the account holder was 59 and a half years of age. Taxable income under the Act, the taxable distributions would also be subject to a mandatory withholding of 35%. These rules would apply to single taxpayers with modified adjusted gross income of $400,000 and married couples with modified adjusted gross income exceeding $450,000. With respect to retirement accounts, the Buildback Better Act also brings an end to the backdoor Roth conversions. Individuals can generally make annual non-deductible contributions of upwards of $6,000 to a Roth IRA. The allowable contribution is phased out to the extent an individual's modified adjusted gross income exceeds thresholds issued annually by the IRS, with no contribution permitted once an individual's modified adjusted gross income exceeds the following amounts: For 2021, those amounts are at single taxpayer, $140,000, a married couple, $208,000. And for 2022, those amounts are $144,000 and $214,000 respectively. Currently, individuals can convert amounts in a traditional IRA to a Roth IRA, regardless of income level. Accordingly, individuals with income in excess of these prescribed thresholds are allowed to make have been allowed to make a non-deductible contribution to a traditional IRA and immediately convert the traditional IRA to a Roth IRA in order to benefit from the tax-favored treatment of Roth accounts. Effective January 1st, 2022, the House-approved bill would prohibit all after-tax contributions in qualified plans and after-tax IRA contributions from being converted to Roth IRAs, regardless of the taxpayer's income level, thereby bringing an end to the backdoor Roth conversions. With respect to Roth accounts or Roth conversions, all of or any portion of a deductible or non-deductible traditional IRA can generally be converted into a Roth IRA, regardless of the individual's adjusted gross income. Taxpayers recognize taxable income at the time of the conversion, but obtain the future benefits of a Roth account, including non-taxable distributions and no required minimum distributions. Beginning in 2032, the House-approved bill eliminates Roth conversions for single taxpayers with modified adjusted gross income in excess of $400,000 and married couples with modified adjusted gross income in excess of $450,000. Another provision that would impact a number of the individuals who have joined our webinar today is the elimination of the enhanced qualified small business stock exclusion for high income taxpayers. Assuming the issuing corporation satisfies specific requirements, 75% to 100% of gain realized from the sale of qualified small business stock held for more than 5 years is currently excludable from taxable income. The 75% exclusion currently applies to qualified small business stock acquired at original issuance after February 17th, 2009 and before September 28th, 2010. While the 100% exclusion applies to qualified small business stock acquired at original issuance after September 27th, 2010. Under the House-approved version of the Buildback Better Act, taxpayers with adjusted gross income of $400,000 or more would only be allowed to exclude 50% of gain realized on the sale of qualified small business stock. These provisions would apply, if enacted, to sales and exchanges occurring after September 13th, 2021. Lastly, with respect to the tax provisions within the Act, just want to cover a couple of other provisions that were in there that could apply to both not only individuals, but also investment partnerships as well. The expansion of the constructive sale rules. The constructive sale rules restrict a taxpayer's ability to defer the recognition of gain on appreciated property when the taxpayer enters into an offsetting position that effectively locks in the gain while also limiting the risk of loss. A taxpayer holding an appreciated financial position is generally deemed to sell the position at its fair market value and recognize gain, but not loss, at the time it enters into one of the following transactions for the same or substantially identical property: a short sale, an offsetting notional principal contract, or a futures or forward contract. Under current law, an appreciated financial position includes only stock, debt instruments, or partnership investments, as well as any futures, forward contracts, short sales, or options on such securities. The Buildback Better Act would also apply the constructive sale rules to digital assets, which are defined within the Act as any digital representation of value that is recorded on cryptographically secure distributed ledger or any similar technology. This provision would apply to any transactions entered into after the legislation has been approved by the Senate and signed by the President. The Buildback Better Act also expands the provisions of the wash sale to include a number of additional securities. To prevent the deduction of paper losses, the wash sale rules defer the recognition of loss from the sale of stock or securities if within 30 days, within a period beginning 30 days before and ending 30 days after the sale, the taxpayer acquires or enters into a contract or option to acquire substantially identical stock or securities. Current law applies the wash sale rules only to stocks or securities, as well as contracts or options to acquire or sell stocks or securities. Again, similar to the provisions with respect to the constructive sale rules, under the House-approved bill, the wash sale rules would also apply to the sale of commodities, currencies, and digital assets. Modifications with respect to the FDAP withholding. Partnerships, trusts, and U.S. taxpayers are generally required to withhold U.S. income tax on certain types of investment income paid or allocated to a non-resident alien or foreign corporation. Interest income on certain obligations qualifying as portfolio interest is exempt from such withholding. Historically, the portfolio interest exemption has not applied if the resident alien or foreign corporation owns 10% or more of the combined voting stock issued by the borrower. The Buildback Better Act would modify the definition of a 10% shareholder to also include any person who owns 10% or more of the value of the borrower's stock. Accordingly, for debt instruments issued after the date of enactment, qualification for portfolio investment interest exemption will be based on vote or value rather than just voting power. Lastly, in addition, the Buildback Better Act also included increased funding for the Internal Revenue Service. In addition to the increased operational funding for the IRS, the Act also provides for an additional $44 billion for enhanced enforcement activities by the IRS. We feel that this is worth mentioning since in combination with the centralized partnership audit rules that went into effect in 2019, we anticipate an increase in audits of investment funds in management companies organized as partnerships over the upcoming years. And with that, I will turn it over to my colleague, Kristen Stone, who will give us an update on carried interest as well as digital assets, as well in digital assets. Thank you, Kristen.
So in our past year's webinars, we've discussed a few different topics, one being carried interest, another being opportunity zones. So as we've evolved for the past few years, we've been monitoring the changes that are going on in both of those regimes. This year, we're seeing that the final regulations were published on January 19th of 2021 for carried interest rules. The effective date essentially is for the 2022 tax years for most taxpayers. The reason being that they were published on January 19th of 2021. Now, if you do have partnerships that were formed after January 19th of 2021, that will have a 2021 effective date for reporting in accordance with the final regulations. Key topics that were discussed in the final regulations really were just clarifications to items within the proposed regulations. Capital interest exception, look-through rule, related party, sorry about that, Mike, related party transfers to family members. There's a family office exception that was discussed in the final regulations, enterprise value, and most importantly, the information reporting. Most of these key topics were really just clarifications. The IRS has acknowledged that the family office exception is not in the final regulations and that there's more study needed around that specific exception. But overall, we're finding that the final regulations were generally consistent with the proposed regulations, aside from some new reporting that finally was released for us. So in 2021, if applying the final regulations, you will have extra worksheets that need to be included with K1s. This will be similar to a K1 footnote, but maybe even have an attachment showing the calculation of the applicable partnership interest that is subject to the carried interest rules under Section 1061. The other thing that's in the IRS FAQs that were released in November 3rd of 2021 was Schedule D reporting. So when an individual receives this new worksheet along with their K-1s from a pass-through entity, they will have to disclose on Schedule D the 1061 reclassification. This is definitely something that's new compared to past years. There's actually a spot on Schedule D or the 8949 where you disclose your capital gain detail. That's called a Section 1061 adjustment. The result would be that a taxpayer would show a short-term capital gain or they'd show a long-term capital gain and show a 1061 adjustment to reclassify the carried interest item to short-term. So those are the upcoming 2021 or 2022 reporting requirements that we're seeing. And that really just depends if you're following the final regulations in 2021 tax year as to whether you need to include the full details that are defined in the final regulations. I would say that even if you choose to follow the proposed regulations or your year-end doesn't fall within the requirement to report under the final regulations, there are still additional footnote items anticipated for 2021. For carried interest, we thought it made sense to just, I've used the term applicable partnership interest a few times throughout this slide. So now that I've given you an update on sort of where we are today with changes in the final regulations and clarifications on reporting, we just thought it made sense to do a refresh on what that applicable partnership interest actually means. The applicable partnership interest, it relates to holders. I'll just read it to you, sorry about that. Holders of an applicable partnership interest are entitled to long-term capital gain treatment only if the underlying assets in the partnership are held for at least 3 years. If the holding period is less than 3 years, the gain will be reclassified to short-term capital gain. The maximum long-term rate currently is 20%, and the maximum short-term rate is 37%. The means of reclassing the applicable partnership interest gain from long-term to short-term achieves somewhat of what the IRS has tried to do with the carried interest loophole closure and increase the rate on these items that are being allocated. An applicable partnership interest is actually defined as an interest entitling the recipient to future profits received in exchange for the performance of substantial services on behalf of a partnership. The partnership must be engaged in applicable trade or business to qualify. That's going to include raising or returning capital, investing, or developing certain assets. There's a broad definition of what an applicable partnership interest is, but generally speaking, for the attendees on this webinar, we will see this a lot in the investment management space and have been seeing it for quite some time. There's a few exceptions to the carried interest rule that remain true with the final regulations. Partnership interests held by corporations are exempt from this rule. That does not include S corporations, of course. Capital interest in a partnership received in exchange for equity. Partnership interest held by employees of certain other entities. And then partnership interest acquired by purchase for fair market value by a non-service provider. And just to reiterate, right now, Massachusetts does not follow federal law when it comes to the reclassification under 1061. So anything that is reclassified to short-term for federal purposes is continuing to be treated as long-term for Massachusetts purposes. So that's it on the carried interest updates for this year. The next item is the investment incentive for opportunity zone investing. This is another topic that we've dug into over the past few years in our year-end roundtable, and been monitoring this for quite some time. Not much has changed as far as the legislation goes for opportunity zone investments. It's more so that during the pandemic, there have been quite a number of extensions. So if we focus first on the extensions, March 31st of 2021 was the last day of the 180-day investment period for taxpayers, whose 180-day period would have ended between April 1st of 2020 or March 31st of 2021. Essentially, during that time period of April 2020 and March 2021, the IRS was giving an extension so that you didn't have to meet the 180-day requirement to roll a gain into a qualified opportunity zone investment. They extended that and gave you a grace period. Similar to that same time frame, an opportunity zone investment has 30 months to substantially improve their asset. During the COVID time frame of April through March 31st, that was also given a grace period, and that time period didn't count towards the 30-month substantial improvement. The 12-month reinvestment period extended up to 12 months if the initial 12-month period was in effect on June 30th of 2021, or 2020 rather. And the most important, I think, from a qualified opportunity fund standpoint, is that the 90% investment standard test failure was deemed reasonable cause if that failure occurred between April 1st of 2020 and March 31st of 2021. And for just a recap on what that 90% investment standard test means, is that a qualified opportunity fund must hold its assets and meet a 90% of its asset test, being the qualified opportunity zone investment standard. So you can only have 10% of your assets that don't qualify as qualified opportunity zone investments. The IRS giving that leeway during April of 2020 and March 31st of 2021 allowed, some of those early stage funds that hadn't fully launched to be able to have a little wiggle room and know they're not going to get penalties if they dipped below the 90%. Key dates that apply as far as opportunity zone investments, one coming up in just a couple of weeks, 12/31/2021. So that's the last date that you can invest in a qualified opportunity fund and receive a tax basis increase of 10% of the deferred gain if you hold the asset over 5 years. 12/31/2026 is when the deferred gain on any asset must be recognized. The qualified opportunity zones are set to expire still in 2028. It's still unknown as to whether those will get extended over time, but for now it's still set at 2028. 12/31/47 is the last date to receive capital gain exclusion on the sale of a qualified opportunity fund investment. We'll be monitoring these dates and any extensions that come out over time, but as of now, I'd say that 12/31/2021 is coming up quickly, and if anyone's looking to close before the year end, there is that added gain deferral incentive to think about. Our next topic is one that's probably very hot in the industry right now, in cryptocurrency. Cryptocurrency investing, we've been watching for quite some time and dedicated a team of resources to focusing on monitoring the tax legislation around this area. There's very little guidance by the IRS. I've referenced here a couple of IRS notices and revenue rulings, and mostly the IRS FAQs that come in handy when it comes to the tax legislation around taxation of virtual currencies. The key topic to consider here is that virtual currencies are considered property for tax purposes by the IRS. That's very different than securities that we're used to in the investment management space. Some big picture items with regard to those being treated as property would be that the sale or exchange is still considered a capital gain or loss on the appreciation or depreciation of the virtual currency. Now, if you were to pay for goods or services via that use of cryptocurrency, there are additional considerations. You will have capital gain or loss recognized by the payer that's selling or handing over the cryptocurrency as a form of payment in exchange for services. However, the recipient is going to receive that cryptocurrency as if it received property at fair market value and recognize ordinary income on the receipt of that cryptocurrency. Of course, once that fair market value is recognized by the recipient, that then would become that recipient's tax basis going forward. Cryptocurrency that's received through mining business operations would be considered ordinary income at fair market value upon receipt. We are seeing a clear distinction where, someone could be engaged in the trade or business of mining and therefore have ordinary income. Holding period is pretty specific right now that FIFO, first in, first out, would be the default relief methodology. You can use specific lot identification if you choose. The holding period is tracked similar to any other property transaction. I would say that what I'm seeing in the industry is that there's a significant volume of transactions, so maintaining that data can be quite cumbersome. Right now, the US source definition is very vague. It's very hard to identify what is US source versus non-US source in some of these cases. And so right now, the US source is the default, if unknown. So what we're monitoring right now, and I know some of these things may overlap with the things that Mike mentioned, so I'll keep that part brief, but the biggest being that we're monitoring 1099 reporting requirements. So, watching to see if this will become effect for 2023 and what that might look like as far as 1099 reporting. If required, we're looking at all different types of exchanges and crypto companies needing to disclose on 1099s when they have not in the past. The other that Mike already touched on was that wash sales, constructive sales, and even potentially straddles could be included in the current House bill. They're expected to be included, and what that would mean is essentially, if you have crypto investors or digital asset investors doing heavy volume of trading, we could be looking at wash sale analysis, constructive sale analysis, and straddles that will definitely bring in an added layer of complexity to the ever-growing tax complications that are happening in the crypto space. When you think of a typical crypto investor, they may be trading on multiple exchanges. And so monitoring these things and doing analysis across exchanges is going to be very important if these do pass. There's a few topics with regard to ECI, which is effectively connected income with the United States, UBTI, which is unrelated business taxable income, and FDAP, which Mike had already mentioned previously. So these are sort of our key terms for US versus foreign income sourcing. Right now, we're assuming things are the US sourced if the source of income cannot be identified. There is an ECI safe harbor extension that will expand to cryptocurrencies if you're trying to determine if a cryptocurrency trading fund is engaged in a trade or business. So that's an added bonus that, it's not necessarily going to be the case that ECI is going to apply to a cryptocurrency activity right away. There's also listing investment type income that's excluded from UBTI and questions around various crypto related income being excluded from UBTI. So all of those things are really, things that we're monitoring and waiting for further guidance and the industry is interpreting as we go. Another hot topic is non-fungible tokens. NFTs seem to be getting a lot of buzz in the industry right now. And what an NFT really is a unit of data stored on a digital ledger. And it can be sold and traded similar to some of your other digital assets. But what's interesting about NFTs is that they're seen widely in the gaming industry right now. An NFT can actually be an image, an animated GIF. So there's games being created where you can form your own NFT and buy and sell those. So creators of NFTs, the question is that capital or ordinary treatment? So right now, if you're engaged in the trade or business essentially of creating NFTs, then the argument is there that this is an ordinary type treatment, not capital gain. Now, if you're an investor in an NFT and you're just purchasing these, the IRS right now, the interpretation is that these could be deemed to be collectibles, taxed at a 28% tax rate instead of a normal, security-like tax rate with short and long-term treatment. So again, all of these things, are moving targets as we go, but we're monitoring them and excited to stay ahead of the topics. And Mike, I think that takes us to our next slide. And so I will transfer over to Marissa for our state response to the SALT limitation.
Thanks, Kristen. As Mike mentioned earlier, the cap on the amount of state and local taxes, or SALT, allowed as a deduction at the individual level has been $10,000 since 2018, or $5,000 for individuals who are married filing separate. However, pass-through entities such as partnerships and S corporations are not subject to this $10,000 limitation. So in response to this 2018 SALT limitation, many states have been creating workarounds. One way that they've been doing this is through entity level taxes. These taxes are calculated and paid by the flow-through entity. And unlike other taxes such as non-resident withholding or composite income taxes, entity level taxes can be fully deducted by the owner. Owners may be eager to take advantage of this new type of tax, but there are many factors to consider. As Mike mentioned, we're waiting to see if the SALT cap will be modified or eliminated for certain taxpayers as part of the Buildback Better Act. We also have to consider each state's specific rules for their entity level taxes. For example, some states have a mandatory entity level tax, whereas in other states it's optional. In addition, we'd want to consider whether the tax is binding for all eligible owners or if certain owners can opt in. So this brings us to the Massachusetts pass-through entity tax, which is a new tax as of January 1st, 2021. Pass-through entities that can pay this tax include a partnership, an LLC treated as a partnership, an S corporation, or certain trusts. This is an optional tax, and the pass-through entity would need to submit an election statement each year with its tax return if it chooses to pay this tax. However, this tax is binding for all qualified members for the tax year in which the election is made. A qualified member includes individual, a trust, or an estate who is subject to the Massachusetts personal income tax, regardless of whether they are a Massachusetts resident. So on the actual tax return, we're going to have to file a new form, the 63D-ELT, to report this pass-through entity tax. The pass-through entity will report each qualified member's portion of the tax on Massachusetts K1, and the amount of tax will be reported as a credit so that the qualified member can pick this up on their personal income tax return. The rate for this tax is 5%, which is the same as the current Massachusetts individual tax rate. However, the qualified member is only able to claim a credit for 90% of what the pass-through entity paid on their behalf. Lastly, this is considered to be a refundable credit. So after the taxpayer aggregates their income from all sources, if there's an overpayment, they can receive a refund. We'll be considering many factors to determine whether this new entity level tax would be beneficial for each of our pass-through entity clients. So feel free to reach out to us if you have any questions about eligibility. Now I invite Rita to walk us through some recent changes to Form W-8, as well as other updates to international reporting.
Thank you, Marissa, and good afternoon or good morning, wherever you are. I'm here to talk to you today about updates in the international section of tax. So this afternoon, we'll start with the W-8 forms. The W-8s are used by foreign individuals and entities to provide identifying information to U.S. payors to document their status for with U.S. withholding purposes, and to also claim any reduction or elimination of withholding because of tax treaty application. There were revised W-8 forms that were released in October of 21. So W-8 and W-8 Ben and W-8 Ben E were released. The W-8 IMY remains in draft. And we bring this up for this discussion today because, U.S. investment funds, U.S. investment managers, without those W-8 forms on file, we're really looking at statutory withholding rates applying to any sources, any U.S. source income that is being paid to these non-resident individuals or entities here. Having these forms on file is incredibly important, making sure, you're not only gathering that identifying information, but you have that information for reporting purposes as well. Why were these forms revised and released? Mainly to reflect updates to the Chapter 3 withholding regulations, as well as to capture the new withholding requirements under the Internal Revenue Code for sales of interest in partnerships that are engaged in U.S. trade or businesses by non-resident aliens or individuals. So noteworthy changes and updates to discuss. We had some additions to the form. On the W-8 Ben E form, a limitation on benefits checkbox was added. Limitation on benefits articles as part of U.S. tax treaties are generally considered to be the anti-treaty shopping provisions of these tax treaties. And it's intended to prevent individuals or entities from being able to use treaties if they're not sufficiently connected to one of the treaty countries. This line was added and must be checked by residents of countries whose treaty doesn't have a limitation on benefits article included in the treaty here. So a bit more understanding of U.S. tax treaties and needing to include that information on the form itself. On the W-8 Ben form, we're adding Part 3, a certification section, which is very similar to the box that's already included on the W-8 Ben E form itself. However, the instructions for the W-8 Ben indicate that this box should only be checked if there is an agent signing the Ben form for the individual beneficiary, basically the individual who's receiving the income. And if that box is checked, a power of attorney needs to accompany the W-8 form when it is provided to the withholding agent. So an interesting update there, and one worthy to note. So, if there is a power of attorney in place, it needs to be provided with that W-8 form if the agent or attorney, in fact, is signing that form for that beneficiary there. Electronic signatures. As we know, our world kind of shifted to the electronic format because of the pandemic. The revised instructions to the W-8 forms allow for electronic signatures, and withholding agents are permitted and encouraged to consider date stamps or other electronic certifications that support when the W-8 was electronically signed. So this is wonderful. We don't no longer need that wet signature. Electronic signatures are permitted. As I stated, as to why these forms were revised, one of the specific reasons is that 1446F withholding and the updates that are required for that. So as I said previously, 1446F applies to sales of interest in partnerships that are engaged in a U.S. trade or business by non-resident aliens or individuals. The forms have been updated to include a taxpayer identification number section. And the instructions indicate that if there is a sale of a U.S. partnership interest that is engaged in a U.S. trade or business, the W-8 forms must include a U.S. taxpayer identification number. So be that an ITIN, an individual taxpayer identification number, or an EIN, an employer identification number. And the instructions also indicate that if this U.S. taxpayer ID number is not included, that the W-8 form is invalidated. So really a very important update and revision to these forms, and something to be aware of. Now, with regard to internal process updates, year-end planning, and the applicability of when these new forms come into play, we wanted to note that the W-8 forms generally are good for a period of 3 years. That at the end of that 3-year period, you need to request additional updated or additional forms W-8. Now, with regard to these new forms being issued, you can still accept W-8, the current versions of the W-8 forms before May of 2022. May 1st, 2022 is that cutoff date. After that date, you must get those updated W-8 bends on file here. For any sales of partnership interests, so that would require that 1446F withholding, you can no longer accept the prior versions. You need that new W-8 version here. So really important things to keep in mind. Year-end planning, as we come up to that 12/31 date, we've been advising our clients here to take a look at those W-8 forms, see which ones are expiring, and if you need to get new ones, and then planning for that May 2022 sort of change over here. That's everything for that W-8 reporting update. And now we're switching to I guess a more general reporting update with regard to schedules K2 and K3. Schedules K2 and K3 were released for the filing season 2022. Several drafts have already been released, and they've been sort of in circulation since 2019. Why are these forms, I guess, being sent out, and why are they necessary? Schedules K2 and K3 are going to apply to partnership returns, S-Corp returns, and any U.S. persons who are required to file Form 8865. These forms are designed to provide greater detail with regard to any items of international relevance. We've seen most of this in the white papers that are attached to schedules K1 right now. The K2 and K3 are designed to provide, I guess, a more standardized format for that. So when we talk about items of international relevance, we're talking about sort of any foreign activities, so income, expense, and we're also talking about any foreign partners as well. They apply, the schedules K2 apply at the partnership level, while K3 applies to the partner level as well. So we've seen that the K2 will be sort of a general summary of that partnership or S corporation level activity. And we're looking at foreign tax credits. We're looking at GILTI inclusion, any specific foreign information reporting related to PFICs, GILTI inclusions of that FDII deduction, things of that level. And then the K3 will break that down, as I stated, to that partner S corporation shareholder level. The forms are fairly in-depth. We're looking at about 12 to 13 parts in total. So it adds on to that compliance, side of things. However, as stated before, a lot of this information was already included in the white papers that were attached to these K1s. However, there are some additional things that need to be broken out. The IRS has allowed for feedback with regard to transitional challenges. So getting all that information into the K2, K3 structure reporting. So instead of just being all spit out on that white level, white paper level, these will actually be included into specific schedules on the form itself, which allows for our tax software to catch up, and also for the reporting to catch up as well. We're looking into a deeper dive into this international realm, and there's some transitional challenges that can start with our clients, updating their reporting. And then finally, the IRS has released Notice 2021-39 with regard to penalty relief in this area. So with this first reporting coming up in the 2022 season, the IRS has basically said, if your reporting is not completely in line yet, we will allow for some penalty relief here as, internal controls change, as procedural controls change with regard to this compliance, and they'll allow for the penalty relief as well. So again, the IRS has this spotlight on international reporting. It doesn't seem like it's going to pick up anytime soon. So we are keeping up to date on all these changes in W-8s, in K-2s, and in K-3s, and making sure that, we're ready to go from that compliance side, and are happy to, talk to our clients and make sure everybody is up to speed on that end as well. And with that, I will give this back to Mike to talk about our inflation adjusted amounts.
Thank you, Rita, and we'll certainly keep this short. As you notice, when you'll have access to the slide deck from today's presentation will be made available to all the registrants. When you do get it, consistent with prior years, what we've done is we've included the last couple of pages 26 through 39, a summary of the tax brackets, as well as various inflation adjusted amounts issued by the IRS on an annual basis, just so you have that for as you go through and do your year-end planning, and also planning for 2022 as well. After a couple of years of flat or minimal increases, recent inflationary pressures have resulted in more noticeable increases in some of these amounts. I think you'll note the one thing that you'll notice as you go through those pages. A couple of the highlights, some of the more sort of frequently thresholds that were asked about. The 401k elective deferral for 2022 is going to increase by $1,000 to $20,500. The Social Security wage base increases to $147,000, up from $142,800. The annual gift tax exclusion, that's going to go increase by $1,000 to $16,000. And the highest marginal rate on ordinary income, that's going to apply to taxable income once taxable income hits $349,901 for single taxpayers and $647,851 for couples. And the highest long-term capital gain rate of 20%, that will kick in for 2022 at taxable income of $459,751 for single taxpayers and $517,201 for couples. You'll see all this information, as I said, in pages 26 through 39 of the slide deck when you do get that. Interestingly enough, one thing that didn't change is the maximum IRA contribution, which for 2022 will stay flat at $6,000. So with that, we'll certainly appreciate everyone joining us today, and I'll hand it over to Stephanie to wrap us up.
Great. Thank you, Mike. And I just first and foremost want to thank all of the presenters for providing us with valuable and informative information to close out the year 2021. If you do have any questions at all, please feel free to contact the presenters directly. Their contact information is included in this slide deck. And as a reminder, the slide deck and recording will be available at wolfandco.com, as well as in the email you received to click on the recording. Please feel free to pass along to any colleagues who may find this webinar useful for their everyday today work. And we really do appreciate your time and participation. And if you would like to request a specific topic for a future webinar, please feel free to reach out to us directly. Have a wonderful remainder of 2021, and we look forward to your participation in future webinars. Have a great day, everyone.